Hi, I'm Jimmy. In this video, we're looking at why the stock market is down huge over the past week and what it could mean for investors. And then I've got a couple stocks that I think that could be very appealing on this dip, and hopefully we can use this and any other stock market drops to help us get closer to our personal goal of achieving financial freedom. Okay, so this is a chart of the Dow Jones Industrial Average. And as we could see with the most recent drop, the Dow has given back a ton of the gains from the past year. This is an almost 13% drop from just a week or so ago. And as we may have seen in the news, much of the fear behind this drop has been related to the escalation of the coronavirus and ultimately the fears as to how far the virus will ultimately go. And given that this is the stock market, well, the stock market is also very concerned about how companies and how company profits are going to be affected. And clearly, this fear is causing a mass selling of some of the world's largest companies. And we can't make any mistake about it. Fear can be a very powerful motivator. And as more people become afraid of the virus spreading and how that could affect different companies, at least in the short run, well, this may very well cause more investors to sell their stock, which could very well force this stock market even lower. So knowing that, what does this correction in the stock market mean for us investors? Well, personally, I think that it's an opportunity, albeit a potentially volatile opportunity. Well, often in times like these, we see a flight to safety. And in theory, the safest investment is the US Treasury. And this is what the yield of the 10-year Treasury looks like over the past year. And once again, we can see that when this dip happened, well, there was a dip in the Treasury yield as well. But this is a chart of bond yields, not stock prices. So why does this matter? Well, we have to remember that the price of the bond and the yield of the bond are inversely related. So if the price goes up, well, the yield goes down, just like it did here. Well, as we could guess, this price is going up and the yield is going down because more investors are pouring money into the perceived safety of the US Treasury investments. Now, this has two effects for investors. First, we know that bond yields are falling, and that means that prices are rising. And this should have led to an increase in value in the bond portion of our portfolio over the past week. So that could be a good thing for investors who at least have some of their portfolio in bonds. But now for stocks, this fall in bond yields actually has a different impact. And for that, we're going to use Warren Buffett to illustrate how this impact can affect stock investors. So before Warren Buffett bought Berkshire Hathaway, he actually started an investment company called Buffett Partnership. And that lasted from the late 50s and into the 60s before he took over Berkshire Hathaway. But here's why I bring this out. One of the fee structures that Warren Buffett had at Buffett Partnerships was that he used something that is known as a hurdle rate today. A lot of hedge funds use them. And basically, here's what it means. So Buffett would get, let's say, 25% of the profits of the fund, but only after that fund cleared the hurdle rate. In Buffett's case, that hurdle rate was 4%. So if the fund returned 10%, well, Buffett would get his cut of the profits on the 6%. That's after the hurdle rate. We get the 6% by taking the 10% return of the fund and subtracting the 4% hurdle rate. Now, the way this relates to us today is how Buffett came up with the 4% hurdle rate. Well, he used the AAA corporate bond rate at that time. And if we're curious, this is the AAA corporate bond rate according to Moody's going back to the 1930s. And Buffett ran his partnership right around this time period. And as we could see, the interest rate was right about at the 4% level at that time. So what does this mean for stocks? Well, if we consider that the interest rate that we would receive on bonds is the baseline return we're going to get. So US Treasury bonds, they're the safest. So in theory, they would pay the lowest rate. Then AAA bonds, although they're much safer than many other company bonds, they're not as safe as treasuries are. So their interest rate would be a little bit higher than treasury bonds, even though they're still quite safe. Then probably you'd have high yield bonds next. And then after that, you'd have stocks, since in theory, stocks would present the most risk. Now, of course, not all stocks are created the same, but as a group, stocks are believed to be riskier than bonds. So to be compensated for that risk, well, we would expect to receive a higher rate of return on investing in stocks than we would in bonds. So our required rate of return for investing should very much be tied to bond yields in general. Buffett tied his to AAA corporate bonds back when he ran the partnership. And this is a very logical connection to make. Let me illustrate real quick. So on this channel in the past, I've done a bunch of company analysis videos. And over the past year or so, I've been consistently using a required rate of return of about 8.5%. So on this chart, that would be right about here. So I expect, or I hope is probably a better way to put it, I hope to get a return of 8.5% on my stock investments. That's what my personal portfolio requires. So what if interest rates were up here today? Well, there's no way that 8.5% would be worth investing in stocks. I would just be investing in these bonds and get a bigger return. So in theory, our required rate of return for stocks should move more like this. Now, I actually don't think we should move our required rate of return around quite that much, but I do think it makes sense to keep an eye on, let's say, corporate AAA corporate bonds to see how our required rate of return stacks up. So when we shorten up our AAA corporate bond chart to, let's say, the past year, well, we can see that rates have dropped about 1%. It's been a bit more than that, but we'll be conservative and round it to about 1%. And it's crucial for us to realize that lower interest rates don't just sort of urge the stock market higher because money is cheaper for companies, and in theory, they can use that money and borrow more and things like that. That helps, that's a part of it, but mathematically, lower interest rates should lead to stock prices being higher because investors should have a lower required rate of return. And that affects a lot of different things. At some point, the interest rates on bonds are going to be too low to be worthwhile, and people come pouring back into the stock market, and the stock market recovers. Okay, now this brings us to some potential companies that could be good after stock market drops lower like it has recently. First, we have Microsoft. Now, I did a video on Microsoft about a year ago, and like I said, I've been using 8.5% as a required rate of return, which is exactly what I used about a year ago. And the conclusion of that video was that I really liked Microsoft as a company, and the stock was about fairly valued at that time. And it probably belonged in our growth portfolio, but I didn't think it was cheap enough at that time to be in our value portfolio. So that was right about here on their stock chart. And as we could see, well, clearly they've done quite well since then. Now, if we were to look at Microsoft's discounted free cash flow valuation today, and we used all the same metrics as we did last year, well, we can see that today's company value, overall company value, is about $134 per share. And if we wanted to account for the value of just the stock, well, the share price would rise to about $140 per share. And the difference between those two numbers, if we're curious, it's simply adjusting for cash and debt. But the important point here is that we're using the exact same assumptions from a year ago, the very same 8.5%. But what if we recognize that because interest rates have been falling, well, it's only logical that we expect a lower rate of return on our stocks. So maybe we adjust our return from 8.5% over to 7.5%. And by changing just that, well, Microsoft's fair value jumps to $162 and $168 per share, depending on which number we want to use. And then when we switch over back to Microsoft's chart, well, suddenly the stock is looking a bit more appealing thanks to both the pullback in the stock and a very reasonable adjustment due to the drop in bond yields. Okay, now we got another company in Leggett & Platt. They're another good example. Now, I did a video on Leggett & Platt just recently as part of our new Dividend Aristocrats series. And in that video, we came out with a fair value of about $52 per share. We also used discounted free cash flow. But you may notice that I made the same mistake that I've been making recently, where I continue to use the required rate of return of 8.5%, just like I have over the past year. Once again, not paying close enough attention to the somewhat drastic drop in interest rates. So if I had used a lower 7.5%, as I probably should have, well, the fair value suddenly jumps up to $62 per share. And then when we switch over to their chart, well, we can see that the lower required rate of return and the pullback in the stock recently makes this a much more compelling long-term investment opportunity. So I think that both Leggett & Platt and Microsoft are good companies to consider. I'm also looking at companies like Disney, which I think is good on a market dip. The Genuine Parts Company, since companies like that have proven to do well in previous stock market crashes. So if you're looking for a few other companies that could do well in a turmoil market like we seem to be in right now, well, I actually did a video called 5 Stocks for a Stock Market Crash. That could be a good next video for you to watch if you're interested. There's a link right here. There's a link in the description below. And I really want to thank you for sticking with me all the way into the video. I really appreciate it. I hope you found this interesting. Thanks. I'll see you in the next video.